some news out of the Federal Reserve, another small tweak in their program to continue supporting credit markets. Brian Cheung joins us now with the latest on this change, Cheung. And I believe you described it as something that makes sense in the context of what the Fed had been doing, even if it wasn't a necessarily expected move from the Fed today.
Yes, Myles. Well, here's the actual change here. The Federal Reserve said that in addition to what it was already doing, which was purchasing corporate bond ETFs through its secondary market corporate credit facility, it's also going to buy individual corporate bonds in the secondary market to comprise what they'll call a, quote, corporate bond portfolio that is based on a broad diversified market index of U.S. corporate bonds, end quote. This would comprise any sort of corporate debt that it had already defined when it set up this facility in late March. That is, companies that have investment grade debt or slightly below that, as long as they were fallen angels after March 22nd. So there's nothing technically new about this. What is new is the Fed's communication that it wants to effectively go out there and decide what types of bonds it finds a part of the criteria that it's set. Keep in mind also, these corporate bonds cannot be of a maturity longer than 5 years, but it seems like the Federal Reserve just wanted to clarify and say, hey, as a reminder, we're not just buying ETFs themselves, we're also buying individual corporate bonds in the market, but wanted to give a little bit more guidance on what that might look like. One reason why this might be happening is because if you think about the Federal Reserve's out when they ultimately get into the recovery, those ETFs, the only way you can get them off your balance sheet is by selling them. So by basically purchasing these corporate bonds, I think the Federal Reserve is hoping that it can just hold them to maturity in what they would effectively describe as a basket of corporate bonds themselves anyway, and then let them roll off as opposed to maybe buying more corporate bond ETFs, which, as we know, Myles, has been a very politically challenging thing for the Fed to do.
Well, and also, Brian, it seems, and maybe this is just my reading on all the Fed announcements, is that they continue to clarify their plans to do various things because it seems like they're worried there won't be enough supply for the amount of demand they've outlined they will have for some of these types of securities. Now, this specific program, right, they didn't start this today. They have a couple of weeks lead time here. But there does seem, at least on my reading, that there's perhaps concern that not enough companies will come to market with the kind of debt the Fed would like to be buying or would like to see in some of the ETFs they are buying. And so this is maybe a signal to say, hey, the window is open here. Please use it.
Well, actually, the Federal Reserve will begin some of these individual corporate bond purchases in the secondary market as of tomorrow. We'll see, based on the statistics from their weekly balance sheet release, how much that's actually going to be. So far, the Fed, as you point out, has not purchased anywhere close to the maximum that it's committed to this facility. Keep in mind, the Federal Reserve committed up to $750 billion for corporate bond purchases if it needed to. As of June 10th, the Fed balance sheet said that it only purchased $5.5 billion of corporate bond ETFs, just a drop in the bucket. And you can also see in the order that they've been unveiling this, what the strategy is here. The Fed also has a separate primary market corporate credit facility where the Fed would go directly to the corporate bond issuer and say, I'll just take on your debt as long as it's less than 5 years of maturity and meets the credit rating standards that we've set forth. That facility, even though it was announced March 23rd, is not set up yet. The Federal Reserve wants to use the secondary corporate credit facility to backstop any sort of ETFs, which are the major buyers of corporate debt, as you know, first before they go directly to those purchasers. I think the Federal Reserve wants to do this for an independence reason, maybe trying to say we want to do as minimal direct distortion to the market as we possibly can, which I think is another big reason why the Federal Reserve did what they did today by saying we might want to prioritize more purchases of the corporate bonds themselves as opposed to these equity ETFs. So I think when we talk about the Fed's future here, we have to understand that these facilities will be standing through September. So it's possible the uptake could get a lot closer. But when you think about the difference between $5.5 billion and $750 billion, it seems like the Federal Reserve's got a lot of ammo there. Not sure what the intention is on the uptake of that program ultimately.
Yeah. Hertz is not eligible? Is that?
Assuming, as long as they were not a fallen angel, I guess, before March 22nd, they wouldn't be eligible for this.
All right. That'll come, I guess, as we get more creative here, equity for bankrupt issuers, maybe whatever the numbers or the letters in that facility would be, you'll be sure to let us know whenever that gets released. All right, Brian Cheung, the latest from the Fed. Again, that news that the Fed will be active in the secondary market for individual corporate issuers, moving markets higher here in just the last hour. Again, we got the S&P now up about 0.9%.
Hey investors, Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.